Welcome to the debate. Today we're diving deep into the macroeconomic intricacies of a highly sophisticated virtual crypto economy. Specifically, we are examining the Layer 2 meme token ecosystem, which is built on top of native county blockchains.
Right.
And the central question we are exploring today is, well, it's a very practical one from the point of view of a player. What is the best way to get rich in the meme token market without actually creating a meme token yourself?
It's a fascinating constraint, honestly, because, creating a token requires capital, marketing, and just immense risk.
Exactly. But participating in the ecosystem built around those tokens, that is where the real systemic wealth lies. We are looking at an environment featuring native county tokens, decentralized order books, automated market makers, and crucially, stable coins, primarily the Wadsworth stablecoin or WSC, and various city stablecoins known as CCC.
Mm-hmm.
I will be arguing that the optimal, most reliable path to wealth is the passive yield and staking strategy. By leveraging the ecosystem's built-in mining and treasury reward pools, a player can essentially create a compounding dollar-pegged cash machine.
And I take the opposing view. While passive yield has its place, I argue that the optimal path to true asymmetric wealth is the active trading and arbitrage strategy.
Okay.
By exploiting order book volatility, instant swap mechanics, and just the underlying algorithms of this economy, an active trader can far outperform the diminishing returns of passive yield farming. When you understand the deviation limits and the volume-weighted average price systems, you're no longer at the mercy of the broader market. You are harvesting it.
Let me lay out the foundation of the passive strategy first, because I believe the underlying mechanics, they inherently favor the liquidity provider and the miner over the long run.
All right, let's hear it.
To build immense wealth without taking on the liability of launching your own token, you need to understand the two-step compounding pipeline built right into this architecture. First, you utilize the mining nodes. Whenever a new meme token is launched by another ambitious player, 90% of its total supply is immediately allocated to a mining pool. You don't have to build the hype, you just have to position yourself in front of it.
And you position yourself by staking your native county tokens, correct?
Exactly. You stake your native county tokens to mine these newly minted meme coins. And the beauty here is the absolute cost efficiency. Staking only costs 0.5 gas units.
Wow.
Yeah, it is incredibly cheap to set up your mining rig, so to speak, and capture a share of that massive 90% allocation. But that is only step one. Holding a volatile meme coin isn't wealth, it's potential wealth.
Sure.
Step two is where the real economic engine turns on. You take those freshly mined meme coins and deposit them straight into the yield farming protocol. By staking your meme coins there, you earn WSC, which is hard-pegged one-to-one to in-game cash, or you earn those city stablecoins.
But you are locking your assets into a smart contract to do that.
You are, yes. But in exchange, the system guarantees highly predictable hourly payouts. Because the smart contracts are hard-coded to execute payouts exactly every 720 ticks. So you're getting a guaranteed yield. It's the meme mining payout interval ticks and the yield payout interval ticks. You are constantly receiving a stream of assets that seamlessly convert to real, usable in-game purchasing power, all while completely isolating yourself from the massive price crashes that inevitably wipe out active traders chasing green candles.
I come at it from a different way. The passive yield pipeline you just described sounds incredibly safe on paper, but it is actually a trap of diminishing returns.
A trap?
Yes, a trap. You are leaning heavily on that initial 90% mining allocation, but you are completely ignoring the mathematical reality of the halving algorithm.
I wouldn't say I'm ignoring it, but I view its impact differently.
But the impact is absolute. The rules of the simulation dictate that meme coin mining rewards halve every 500,000 tokens minted. That's the meme halving interval. It is modeled directly after Bitcoin's halving, but on a hyper-accelerated timeline.
True.
So those early passive gains decay rapidly. If you sit back and rely on your hourly payouts, your slice of the pie shrinks exponentially as the token supply inflates. The halving steamroller is constantly eroding your baseline yield. True wealth in this ecosystem isn't generated by passively accepting a shrinking reward. It is generated on the order books.
By active trading. The sheer risk involved in trading meme tokens on decentralized order books is astronomical.
It is only risky if you are trading on emotion. An active trader tracks the hourly candlestick data, the open, high, low, close, and volume, the OHLCV data. By utilizing the 24-hour volume-weighted average price mechanics, the VWAP, a trader can systematically and aggressively buy low and sell high. What makes this ecosystem so uniquely profitable for the active trader is the price deviation limit.
Right, the 20x factor.
Exactly. The system mathematically allows for up to a 20x factor in price deviation from that average.
Which is a staggering amount of volatility.
It is. That means there is massive, explosive volatility available to harvest. But because it is capped at 20x, it is structurally protected from infinite runaway manipulation. You get the massive percentage swings, but with a mathematical safety net built right into the code. You know exactly where the ceiling and the floor are relative to the average volume. That is how you build outsized wealth. You don't build it by picking up pennies in front of a halving algorithm. You build it by capturing the massive price swings that the system explicitly allows.
I'm not convinced by that line of reasoning, because you are evaluating the halving decay in a total vacuum.
How so?
You are looking at the direct token emission and concluding the strategy is flawed, completely ignoring the broader macroeconomic subsidies that support the yield farming ecosystem. Yes, the halving schedule aggressively reduces the direct meme token emission, but the yield farming ecosystem doesn't just rely on new tokens. It is heavily subsidized by the wider economy. Let's look at the WSC Treasury Pool. It is essentially a self-sustaining cash printer, and ironically, it is funded by players exactly like you.
Funded by active traders?
Precisely. Every time you, as an active trader, use the automated instant swap feature to jump in and out of a volatile position, there is a 3% fee. The system takes 90% of the value of all those burned instant swap fees and immediately remints it as fresh WSC into the yield farming pool. Another 30% goes to the faucet, and the final 30% goes to airdrops. The entire ecosystem is literally designed to tax the hyperactive traders and redistribute that wealth to the passive stakers. Even if the underlying meme token emission halves, the stablecoin yield pool remains constantly funded by the velocity of your trading.
I'm sorry, but I just don't buy that. Let me tell you why. Your entire argument rests on the premise that the stablecoin yield pool relies on active traders constantly paying those 3% swap fees.
It does rely on that.
Right, so if you are just a passive staker, you are entirely dependent on the volume generated by people taking actual risks. If the trading volume dries up, your yield pool dries up. So why position yourself to take the trickle-down yield when you can be the trader capturing the primary market movements?
Because the trickle-down is guaranteed by the code, and the primary market movements can turn against you in an instant.
But furthermore, a truly skilled active trader isn't blindly paying maximum fees on instant swaps anyway. This is a game of optimization. By engaging directly with the decentralized order books rather than relying on the automated instant swaps, traders face a much lower fee structure. It is only a 2% total fee on the order book.
That's still a fee.
Yes, but look at how it's split. 1% to the token creator, 0.5% to the treasury, and 0.5% burned. So your massive influx of WSC from swap fees, that is only coming from the amateur traders. The professionals are bypassing that tax entirely. By being a passive farmer, you are accepting a derivative secondary income stream while exposing yourself to the immense opportunity cost of having your capital locked up in a staking contract while the market moves 20x.
That's an interesting point, though. I would frame it differently. You talk about optimization, but I think you are missing where the deepest optimization in this game actually lies. It doesn't come from just dodging a 1% fee difference between an instant swap and an order book transaction. The real optimization comes from executive synergies, and the math there objectively favors the passive staker over a long time horizon.
Executive synergies are powerful, I'll grant you that. But how do they overcome the baseline decay of your strategy?
Let's look at the specific in-game crypto executives you can hire to multiply your wealth. If I am running a passive yield strategy, I am immediately going to hire a DeFi specialist. That executive's innate ability natively boosts all yield farming and staking returns by 15% across the board.
Okay.
On top of that, as my operation expands, I can hire an executive with the token strategy ability, which boosts meme coin and WSC yield by an additional 10%. Because those smart contract payouts happen predictably, precisely every hour, these executive buffs act as a compounding multiplier on an already subsidized return.
But 25% more of a shrinking pie is still a shrinking pie.
It is a shrinking pie of the meme coin emission, yes. But remember, the stablecoin rewards driven by market velocity are also being boosted. The passive staker doesn't just earn a trickle. They earn a mathematically optimized, executive-boosted waterfall of WSC that is fully pegged to the in-game dollar. You gain an incredible psychological advantage here as well. You don't have to time the market perfectly. You don't have to endure the stress of staring at candlestick charts, waiting for a deviation spike to capture that value. The peace of mind combined with guaranteed compounding allows a player to focus their attention on other aspects of the game's economy.
That's a compelling argument, but have you considered the executive strategy available to the active trader? The passive buffs you mentioned are certainly nice quality of life improvements, but the active buffs literally rewrite the rules of market engagement. They change what is mathematically possible on the order book.
How so? A fee reduction is just a fee reduction.
It is much more than that. If I hire an executive with the blockchain native ability, my crypto transaction fees are immediately reduced by 20%. That heavily mitigates that 2% total order book fee we discussed earlier. Suddenly, the friction of trading is drastically lowered. This allows me to execute high-frequency arbitrage trades that would otherwise be unprofitable due to baseline fees. I can step in and take profits on minor fluctuations that a normal player simply couldn't afford to touch.
So you are making more trades, taking more risks, just to harvest smaller margins?
Not necessarily smaller margins, but more frequent, guaranteed margins. And it goes deeper than just fee reduction. Consider the data analytics executive ability. This is perhaps the most powerful tool in the game for a trader. It explicitly reveals live market trends across all assets. It gives traders near-perfect information to front-run the market. I can see the volume building before the average price deviates. And if I want to automate my strategy to match your peace of mind, the algorithmic trading executive boosts automated trading positions by 5%.
But you still have to set the parameters for those automated positions. If the market turns, your algorithm might just execute a series of terrible trades faster.
That is where skill comes in. You are using executives to get a slightly larger percentage of a halving reward pool. I am using executives to gain structural omniscience over the entire order book. I am reducing my friction and amplifying my ability to systematically exploit those 20x price deviations. The wealth multiplier for having perfect information in a volatile market will always outweigh a flat yield boost on a stablecoin pool.
I see why you think that, but let me give you a different perspective. All the perfect information, the algorithmic boosts, and the massive 20x price swings in the world absolutely do not matter if you cannot cash out. The concept of wealth in this ecosystem, well, in any crypto ecosystem really, is inherently tied to liquidity and the exit strategy. A massive portfolio value is meaningless if it is purely unrealized gains.
Slippage is always a factor, yes, but it can be managed.
It is more than just a factor. It is the fundamental bottleneck of your entire strategy. The yield farming route directly produces WSC and CCC. These are not speculative assets. They are natively redeemable for in-game legal tender at a hard one-to-one peg. When my DeFi specialist boosts my yield, I am accumulating hard purchasing power. The active trader, on the other hand, is holding a portfolio of highly volatile meme coins. Let's be honest, they are essentially joke tokens with no underlying utility.
Their utility is their volatility.
But that volatility is a double-edged sword. You might look at your screen and see a massive unrealized gain because the average price spiked up 20x. But when you actually go to the order book to sell your massive position and lock in those gains, you are going to encounter catastrophic slippage. The liquidity simply might not be there to support your exit at that top price. there might not be enough buyers on the other side of your perfect algorithmic trade. The passive farmer builds wealth in the exact currency that matters, while the active trader builds wealth in illusions that can evaporate the moment they try to realize them.
I come at it from a different way, because the slippage argument assumes the active trader is foolish enough to dump a massive, illiquid position entirely on a thin order book. No professional trader does that. A sophisticated trader intimately understands the underlying automated market maker mechanics that act as the ultimate backstop for liquidity.
The AMM pools? Those are subject to even more dramatic slippage if the reserves become unbalanced.
Only if you don't understand the math. The AMM pool, specifically the native to WSC pool, ensures there is always an exit route. The AMM uses a constant product invariant formula. Without getting bogged down in textbook recitation, it simply means the balance of asset A and asset B must always equal a constant ratio. It's K equals reserve A times reserve B.
Right, standard AMM math.
Exactly. Because the system deliberately seeds these initial pools with 10,000 WSC and 10,000 native tokens to establish that baseline invariant. A smart trader, especially one armed with a data analytics executive, can calculate the exact curve of the slippage before executing the trade. I know exactly how much WSC I will extract before I even click sell.
But you are still draining the reserves. If multiple active traders try to exit at the same time during a 20x spike, that invariant curve becomes incredibly steep. You will be walking away with pennies on the dollar.
And that is exactly why speed and automation are paramount. But more importantly, let's look at where that liquidity comes from. The active trader uses the very WSC liquidity pools that the passive farmers are funding. We swap our volatile meme coins through the automated market maker, extracting the hard-pegged WSC from the reserves. We don't need to hold the volatile assets long-term. We don't marry our bags. We just ride the 20x deviation, swap through the AMM using the constant product curve to mathematically secure our exact stablecoin output and exit. The active trader is essentially using the passive farmer's locked liquidity as their personal exit strategy.
That is a highly predatory way to view the ecosystem. But I understand the mechanics of what you are describing. However, relying on extracting liquidity from pools funded by others means you are always playing a game of musical chairs. If you aren't the first one through the door when the market turns, the constant product curve will ensure you are the one left holding the volatile tokens.
Which is why the psychological profile of the active trader is so different. You have to be comfortable with that pressure. You have to be comfortable trusting your algorithms and your executive bops to execute faster than the crowd.
To summarize my position, building substantive wealth in this highly complex meme token market without taking on the burden of launching your own token is best achieved through a disciplined, structural strategy. By leveraging the incredibly low gas costs of early mining deposits, stacking those meme coins into yield farming protocols, and optimizing your returns with crypto executive buffs like the DeFi specialist, you create a compounding cash machine. This approach isolates you from the inherent risks of order book volatility. Most importantly, it directly yields dollar-pegged Wadsworth stablecoin and Citi stablecoins, ensuring that your virtual wealth is always fully realized, insulated from slippage, and immediately usable within the broader macroeconomic game. It is the strategy of the architect, building a sustainable infrastructure.
And to summarize my stance, while the passive route offers peace of mind, the aggressive decay of mining rewards due to the 500,000 token halving rule means that passive yield is ultimately a game of diminishing returns. The only path to outsized, truly asymmetric wealth is active order book trading. By utilizing fee-reducing executives like the blockchain native, leveraging data analytics for perfect market information, and safely exploiting the massive 20x price deviation limits around the average market volume, a skilled trader can harvest incredible volatility. And you don't need to fear illiquidity if you understand the constant product AMM mechanics, which allow you to extract stablecoins on your own terms. It is the strategy of the apex predator, capitalizing on market inefficiencies.
It is absolutely fascinating how deeply intertwined these two approaches are with the macroeconomic systems of the game. Despite our differences on the optimal path, we certainly converge on the fact that both strategies ultimately rely heavily on the Wadsworth stablecoin. The stablecoin is the foundational bedrock. Without WSC to realize virtual wealth into usable in-game dollars, neither the yield farmer nor the active trader has a reliable exit strategy.
Absolutely. We also completely agree that navigating this Layer 2 ecosystem naked, meaning without hiring the right crypto category executive, is a massive unforced error. Whether you need the DeFi specialist to optimize your yield waterfall or the blockchain native to reduce your trading friction, executive talent is absolutely mandatory for either playstyle to actually work at scale.
Ultimately, the optimal approach likely depends entirely on a player's real-life time commitment to the game and their personal risk tolerance.
Exactly. A passive player can afford to step away, let the hourly payouts accrue, and sleep soundly. An active trader needs to monitor those market trends, set up their algorithms, and be ready to execute when the deviation spikes.
There are clearly far more layers to explore within these county blockchains, automated market makers, and Citibanks. The depth of this simulation is truly remarkable. Thank you for joining us as we explore this ecosystem. We will leave it to the listener to decide which strategy best suits their portfolio. Goodbye for now.